Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Mark Marex, Senior Director of Index Research at Nasdaq, as well as Garrett Paolella and Troy Cates, co-founders and managing partners of Neos Investments. We're here to discuss the growth in options-based ETF strategies and what investors should be aware of. It is great to have everyone with us. Welcome to Trade Talks. Garrett, let's kick this off with you. Options-based ETF space, it continues to grow in popularity. Let's talk about NEO specifically. What sets QQQI apart and what has contributed to its continued success?
Sure. So it's really been the hunt for tax efficient income by investors. And so QQQI is really trying to deliver a consistent monthly distribution as well as capturing upside. These option based products, if you think back over the last decade, have really just focused on the income generation. And so that upside component hasn't been there. Neos is really focusing on being able to deliver on both facets for investors to give that income opportunity on a monthly basis, but also appreciation within the equity markets. And I think that also allows us to leverage the Nasdaq 100 within the overall portfolios. That's like the key focus and benchmark, that we're investing in. And lastly, I think investors have really seen how these types of products can fit within overall asset allocations and complement their long only exposure within equities or other areas of their portfolios that they're trying to generate income from.
Yeah, and certainly industry has taken notice, having been awarded the best new active ETF at the 2025 ETF.com award. So congratulations on that. Mark, I want to get your thoughts on this with the growth that we're seeing on options-based ETF strategies within the wrapper.
Yeah, sure. Thanks, Jill. Look, the results speak for themselves. This is one of the single best performing products in terms of flows for the entire NASDAQ index suite year to date. I think, part of why investors are responding to products like this, especially around the NASDAQ 100, is that, they realize using it as a sort of foundational benchmark to build an option strategy around. It offers something a little bit differentiated from the S&P 500, right? And that is at the same time as you're getting sort of superior long-term annualized performance, go back about 20 years, that's about 5 percentage points of annualized performance incremental versus the S&P per year. You're only taking on a little bit more risk in terms of volatility, but you are taking on more volatility, right? And so if you're looking to combine generating options income, you're going to get more premium selling against a benchmark that's higher vol to begin with. Add that on top of something that has higher upside potential versus the broader market on top of that, and you have a really powerful package. And I think that's part of why, QQQI has been doing so well.
Yeah, and Tony, certainly there are a number of variables in this market for investors to navigate. We have interest rates, geopolitical concerns, of course, valuations as well. How might a strategy like QQQI help investors navigate these risks?
Sure. I think Mark really hit the nail on the head there when he was talking about the added volatility that you get. So when you think about interest rates and rates are starting to come in now and probably future rate cuts, where we're sourcing the income from is the volatility in the options market around the Nasdaq 100. And with that added volatility, as Mark was describing over, say, the S&P 500, you're getting more premium on a monthly basis that can be distributed out. So when you think about all this geopolitical risk, there's headline risk. We saw what happened in April with the market selling off on the tariff announcements and then bouncing back quick. But with that, we saw a very big increase in the volatility market. And with that, we were able to bring in a lot more income. But the way these products work, as Garrett was walking through earlier, is we really want to capture the upside of the NASDAQ 100. And so when volatility increases, it gives our models an opportunity to write further out of the money, to write on less of the notional in the portfolio. And that gives you some more upside appreciation potential when the market moves higher. So that's what we really focus on, is not only the actual income, but capturing a good portion of the upside while distributing a tax efficient income.
Right. And you also have the QQQH, Troy. What would be the differences between with that and QQQI?
Sure. QQQH, so still long the same NASDAQ 100 basket of stocks. So you're still getting that underlying exposure. And we're taking some of that premium from selling the calls, similar to QQQI, but we're taking some of that premium and buying a long put spread. And with that long put spread, it gives you a measure of downside protection. So your overall portfolio has a lower volatility and can weather and smoothen out the return profile while still giving you a nice monthly income.
Right. And Garrett, let's get back into the high degree of tax efficiency for a moment here. How does QQQI aim to achieve this?
Sure. So for QQQI, we first trade Nasdaq 100 index options. And for anyone who doesn't know, a index option gets categorized as a 1256 index contract, meaning it's settled for cash. And when that happens, on a tax standpoint, 60% of your gains are taxed at a long-term capital gains rate and 40% at a short-term. So we're first taking advantage of using the Nasdaq 100 index options for that really tax-efficient component. In addition, our models have a tax loss harvesting element. So we're rolling our options at our rebalancing periods to also take a look at whether the portfolio can generate a potential loss to pair against a gain from an income standpoint. So something a lot of advisors and investors do on an annual basis within their portfolios. And then, of course, that ETF wrapper, because these products, QQQI and QQQH, both sit as ETFs, that allows us some tax advantages as well, like those losses that we could capture within the investment process. If we have excess losses, we can carry those forward indefinitely to use for tax benefits in the future. And so I think as you think about QQQI or QQQH, the idea is really like a multi-leg approach, that these are income-oriented products. And if you're investing for income needs, you want that income to be as tax efficient as possible so that come April, you're not having a large tax bill and the return that you thought you just earned over the last 12 months ultimately loses half of that potentially, out to taxes.
And Troy, what should investors be aware of when they're evaluating options-based ETF strategies?
I think one of the most important thing is all option strategies are not created equally. So when you're looking at this, don't just look at the income coming in on a monthly basis. I think you really need to dive in. The great thing about ETFs is they're transparent. You can go on our website and look at our holdings or our competitor's website and understand what's actually in the portfolio. And then going from there, really look at the total return, because that includes whatever distributions are going out. So it's important to look at both of those, total return, then the income, and then really dive into, is it a tax efficient income? Are you paying all ordinary income on a yearly basis on all your distributions? So it's important to understand that. But you got to dive in and do your homework, because there's so many new products coming out. We see them every day being listed, month over month, more and more products. So I think in the end, the investors really need to do a little homework and dive in.
Yeah. And finally, Mark, from your perspective, as we're talking about these different types of strategies and the nuances.
Yeah, right, Jill. So I mean, as I mentioned, we've got a whole suite of these products now tracking either, NDX directly with sort of an active management overlay, or various, even I would say, sort of passive systematic strategies that combine NDX with some sort of option strategy, whether that's a covered call or downside protection type of a strategy. The world is the investor's oyster at this point, right? And I think the beauty of this space is that you can really see the value of active management sort of competing with going fully passive, because options trading is sort of not the easiest thing to figure out from a fully systematic basis. I think the value prop is very clear in the case of this product. And again, it all kind of comes back to what are you trying to achieve for the investor at the end of the day? Obviously, people are very interested in total returns, right, and performance, but to a lot of people, income matters. To a lot of people, downside protection matters. So whether you're talking about QQQI, QQQH, or something else, it's incredible to see the innovation and just the depth of product that we've launched over the past just few years now. It's over $50 billion for us as a portfolio when you look at the NDX option suite today. And it is the fastest growing subset of our entire index license lineup. So really excited to see where it continues going from here.
All right. Appreciate all of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.